Dear reader, if you are holding this book in your hands, chances are you've come to realize that trading is not just about charts, indicators, or strategies. It's about something deeper, the ability to adapt. I've been in the markets long enough to learn that no single method, no matter how statistically sound or historically profitable, survives all market conditions. What separates consistently profitable traders from those who fade out isn't intelligence, luck, or access to secret tools, it's flexibility. The ability to shift, pivot, and evolve in response to a constantly changing environment is the cornerstone of long-term success. The Flexible Trader is not a traditional trading book. It's not a promise of overnight riches or a list of top-secret indicators. It's a conversation, a brutally honest look into what it means to survive and thrive in a game where the rules are always changing. Inside these pages, you'll discover how to recognize early signals of trend shifts, adapt your mindset to stay emotionally resilient, and modify your strategies before the market forces you to. Whether you're a beginner overwhelmed by noise or a seasoned trader looking to sharpen your edge, this book aims to give you one of the most valuable assets a trader can have, adaptability. I invite you to read with an open mind. Question your assumptions. Rethink your habits. And most importantly, be flexible. Here's to trading smart, evolving fast, and lasting long. Warm regards. Parth Ram Sunder and Mark Peterson. Author, The Flexible Trader. Chapter 1, The Myth of the Static Strategy. The trading world is brimming with strategies. Swing strategies. Breakout strategies. Moving average crossovers. Bollinger Band bounces. Fibonacci retracements. You name it, there's a course, a backtest, or a self-proclaimed guru promising that this system is all you need to beat the market. But here's a sobering truth that every serious trader eventually learns, often the hard way. There is no holy grail. There is no one-size-fits-all strategy. There is only context and your ability to adapt to it. This chapter is not about debunking the tools or tactics you may use. It's about something far more important, understanding why even the most well-tested, statistically sound strategies can fall apart, and how the rigidity of belief in them can destroy a trader faster than any bad trade. The comfort of the static strategy. When you first enter the world of trading, there's a powerful temptation to search for the strategy. A method that works all the time. A setup that prints money. A repeatable formula that removes uncertainty and emotion from decision-making. And there's a reason for that. The human brain craves certainty. We want to believe that if we follow a specific sequence of steps, we'll get consistent outcomes. This logic works in many areas of life: baking a cake, changing a tire, building a shelf. If you follow the instructions, it usually works. But the market is not an instruction manual. It is a dynamic ecosystem driven by countless variables, macro events, sentiment shifts, institutional flows, earnings, fear, greed, momentum, and sometimes sheer randomness. It's not a system you control. It's one you learn to navigate. A static strategy may give you structure. It may work beautifully in certain conditions. But when the market changes, when volatility contracts, trends dry up, or momentum turns choppy, that same strategy can turn from an asset to a liability. Why even great strategies fail? Let's consider a classic moving average crossover strategy. Suppose your system tells you to buy when the 20-day moving average crosses above the 50-day. You backtest it over 5 years, and it shows solid returns. You implement it, gain some confidence, and maybe make a few wins. But then comes a prolonged sideways market. Suddenly, you are getting whipsawed, buying the highs, selling the lows, and bleeding capital. Is the strategy broken? No. Is the market different? Yes. Your strategy was built, tested, and optimized in a certain environment, perhaps a trending market. But when the conditions change, your tool is now misaligned. It's like using a snowplow in the desert. Technically functional, but wildly inappropriate. And here lies the core problem with static strategies. They assume market conditions are constant. But markets are never constant. They trend, range, reverse, expand, contract, accelerate, stall, and sometimes do all of that in a week. Rigid trader versus adaptive trader, a tale of two mindsets. Let's bring this to life with two real-world trader profiles. Trader A, the technician. David was a classic technical trader. He had developed a solid breakout strategy using support resistance levels and confirmation from RSI and volume. He even automated alerts and followed the process with military precision. In 2020 and early 2021, during a highly bullish and volatile post-COVID recovery, his system worked like magic. Breakouts followed through. Volume spikes led to clean moves. His win rate was over 65%, and he was doubling his capital every few months. But then 2022 arrived, and with it, uncertainty. Inflation data, rate hikes, geopolitical tensions, and market-wide chop. Suddenly, breakouts turned into fakeouts. The same setups that once yielded clean gains now reversed violently. But David kept trading the system. He believed in the backtest. He believed in sticking to the plan. He was proud of his discipline, but blind to his rigidity. By the time he realized the market had changed, he had already given back most of his gains. Worse, he had lost confidence, not just in his strategy, but in himself. Trader B, the observer. Contrast that with Meera, a discretionary trader with a flexible playbook. She had a few go-to setups, including breakouts, mean reversion trades, and trend-following systems, but what made her different was how she decided when to use each. Every morning, she didn't just scan for setups, she scanned for context. Times was volatility expanding or contracting? Times was the market respecting levels or chopping through them? Times was participation broad or isolated? Times were institutions active or sitting out? If she noticed breakout attempts failing consistently, she'd pivot to range plays. If she saw momentum building, she'd ride trends more aggressively. And if nothing made sense, she'd step back, journal, and wait. The result? Her profits weren't explosive, but they were consistent. More importantly, her drawdowns were shallow, and her confidence remained intact because she had built a habit of adapting, not just reacting. The dangers of over-optimization. Another symptom of static strategy thinking is over-optimization. Many traders fall into the trap of tweaking their strategy to fit past data, adding filters, adjusting parameters, finding the perfect settings that maximize historical returns. This creates the illusion of robustness, but it's often just curve fitting. The strategy becomes so tailored to the past that it fails in the future. It becomes fragile. What's worse, the more optimized a strategy becomes, the less adaptable it is. It's like building a car that runs perfectly on one specific road surface, but the moment it rains or the terrain changes, it skids off. Markets reward robustness, not perfection. The illusion of control. Rigid traders often cling to a strategy because it gives them a sense of control. If I just follow this system, I can eliminate emotion. But in reality, markets don't respond to our systems, they respond to collective human behavior, macro events, liquidity flows, and much more. When a trader sticks to a system without adapting to the broader environment, they are not being disciplined, they are being delusional. There's a difference between discipline and dogma. Times discipline is sticking to a process while remaining open to feedback. Times dogma is sticking to a process while ignoring reality. The market punishes dogma. Signals of a market shift. If a trader wants to become more flexible, the first step is learning to recognize when the market has changed. Some early warning signs include: times previously reliable setups begin failing frequently. Times volatility contracts or expands significantly. Times volume patterns shift, example, breakouts on low volume or heavy selling into strength. Times indicators become less predictive. Times sentiment changes dramatically, example, from greed to fear or vice versa. In such moments, the worst thing a trader can do is double down on the failing strategy. The best thing: pause, observe, and recalibrate. Adaptation is a skill, not a guess. Flexibility is not the same as randomness. Adapting doesn't mean abandoning structure. It means having a framework that allows for change. Think of it like a sailboat. You don't control the wind, but you control your sails. A skilled sailor doesn't complain when the wind changes direction. They adjust the sails, shift their weight, and find a new path forward. That's what a flexible trader does. The myth of the static strategy is one of the most dangerous beliefs in trading. It offers certainty where none exists. It feeds ego under the guise of discipline. And it sets traders up for failure the moment the market does what it always does: change. But by letting go of this myth, you open yourself to something far more powerful: resilience. In this book, we will explore how to read the market's language, identify subtle shifts, and modify not just your strategy, but your mindset, your process, and your habits. Because in the end, the most valuable edge isn't a system, it's your ability to adapt. And that starts with letting go of the illusion that what worked yesterday will work forever. Thank you for listening to Introduction and Chapter 1. Please click on the link in description to get access to complete book in English and Hindi. Wishing you all the success in trading markets.